All right. Good afternoon. Good morning. Kirk Materne, head of enterprise software research at Evercore. Really excited to have the team with Adobe here with us here today. Dan Durn, SVP and CFO, as well as Doug Clark, VP of IR. We're going to run through a bit of a sort of fireside chat with me and Dan for about 25, 30 minutes. Then we'll open it up to Q&A. If you want to come in on Q&A, just raise your hand. I'll bring you in, or I think you can just ask questions through the Q&A panel. I'm happy to ask them on your behalf, or just shoot them to me at kirk.materne@evercoreisi.com. And I'm again happy to answer them anonymously on your behalf if that's the way you want it. But why don't we just jump into it, Dan? Thanks again for your time. Obviously, you guys just wrapped up earnings a couple weeks ago. Just why don't you start there? Just sort of takeaways from your end, highlights from the quarter in your view, and then maybe we'll go from there.
Sounds good. And it's great to be with you today and appreciate the opportunity to have a chat. So as you all saw, really nice quarter, nice beat and raise on the quarter, top line, bottom line, growing double digits, RPO driving it over 20 billion now, growing 13% year over year. Cash flow from operations was a record for Q3, 2.2 billion. You saw the disclosures on both AR influenced revenue of now greater than 5 billion, AI first revenue, which are brand new products, which are primarily driven by new capabilities around generative AI. We've already hit our full year target of greater than 250 million of ending ARR, as well as raising our guide for DME ending ARR, as well as revenue and EPS. So really nice performance. When I break it down to the customer groups and the audiences we target, introduced Acrobat Studio, which brings the best of the Acrobat ecosystem together into an integrated set of capabilities to drive knowledge hubs, driving faster time to insight. You take a look at MAU, greater than 700 million MAU in this business, business professionals and consumers. We touch almost 1 in 10 people on the planet, and it's growing around 25% year over year. So growth at scale. You can see ending units for AI Assistant for Acrobat growing 40% in the quarter. Express landing and expanding with 14,000 businesses in the quarter, which is a 4x increase from the year ago period. And students with Acrobat Premium are up 80% year over year. So really nice performance in proliferating across business professionals and consumers. When we think about the creative space, continue to introduce functionality into our flagships, AI functionality into our flagships. You think about Harmonize in Photoshop, you think about Turntable in Illustrator, 2 latest examples of deepening the engagement embedded within the workflows that the customers know and love. Continuing to round out and proliferate third-party models, best of breed third-party models, inline natively into those workflows across the Adobe ecosystem. From Google, you're talking about Imagine and Veo and Flash 2.5. You think about OpenAI's image model, Runway, Pika, Flux. All of that natively accessible within those workflows. You think about unit growth within Creative Cloud with particular strength in emerging markets. Firefly app monthly active users up 30% year over year. You see strong adoption of Firefly services growing greater than 30% and custom models growing almost 70% in the quarter. So really landing around this new generation of innovation, productizing it, and driving strong customer engagement. And then from a marketing professional standpoint, you look at AEP and apps growing 40% year over year. Gen Studio now over $1 billion for us, growing 25% year over year. Early introduction of LLM Optimizer, which is going to be a really critical capability so that brands can maintain relevance in both a search-centric as well as LLM-centric world. And then you see the cross-cloud solutions at the company up over 60% in the quarter. So really nice print, really nice guide, clearly momentum from a product standpoint across multiple vectors.
That's super helpful as a table setter. Just on the digital media front, I know you guys don't guide quarterly anymore, but obviously it's the fourth quarter, so we can all sort of imply into what that is. I think one of the questions is you just mentioned, a lot of things that are going right, yet sort of the aggregate sort of infers a little bit of deceleration in the fourth quarter. So can you just explain maybe what are the things that are sort of offsetting some of the growth, just so we understand them? Because a business your size, there's always going to be things that are going really well, but there's probably some things that are, either motions that are different in terms of downsell, people down out. Maybe you just explain that to us, because I think there's some people who are like, hey, why don't you just take the 250 and add that on to last year's number, and like, why aren't you accelerating? And I'm sure there's some nuance to that maybe you could add some color to.
Sure. As we abstract one layer from a lot of the momentum that we see happening across the portfolio, what you would observe, or what I would observe or comment on, is there's a broadening of the product portfolio at play. In the past, when you come to Adobe.com, you sign up for all apps, you sign up for a single app, or you leave Adobe.com and go elsewhere to find something that is more tailored to your use case specific needs. And we had a lot of people coming and signing up for single apps and all apps that ultimately, from a use case standpoint, are probably more casual users. And as we broaden the product lineup, as we drive the freemium funnel around business professionals and consumers with both Acrobat and Express, as you think about broadening the product lineup with great applications like the Firefly app, there's different landing spots now for customers who come to Adobe.com and we're really meeting them where they are, use case specific needs, and the surface area of choice, whether it be web or mobile. So the proliferation of choices across multiple dimensions of the product portfolio give customers a different profile on how they land. When you think about the growth algorithm, the second leg is to cross-sell and upsell. And as we bring people deeper into the ecosystem and make them successful based on those use case specific needs, there's opportunities to cross-sell and upsell over time that leads to a better lifetime value of the customer, as opposed to a limited number of choices initially that are professional in nature and may or may not meet our customers where they are. So that broadening of the product lineup is an important overlay across this momentum that we see from strong uptake of the new innovation that we're bringing to market.
Okay, and so if I think about that, go ahead, Doug.
I've gotten this question a number of times from investors, so I do want to clarify something that you kind of pointed out at the end of your question, which is the over $250 million from AI first ARR is incredible momentum and does show the traction across a number of different new solutions specifically. I do want to remind folks that there was some ARR within that, those products in the prior year. So that $250 million isn't all necessarily incremental to this year. And on top of that, where people are trying to draw the connection to DME specifically, do remember that Gen Studio for performance marketing as one of those products does cut across both the digital media and the digital experience side. So it is certainly a reflection of the momentum and the traction with those solutions. That ecosystem will expand as we bring new capabilities to market over time. But I did just want to draw that specific nuance to that question that you pointed out, that it's not a pure incrementality to this year, and it's not solely embedded within the DME segment.
Okay, and I guess, Dan, to your point about sort of the broadening of the landing, if you will, of new customers, have you had enough, I guess, evidence of those cohorts coming back and upselling and cross-selling to feel good that the aggregate, meaning, might be a little bit of a headwind, I imagine, on just average price points now, but obviously the idea is to get back to where it is. When do you think you'll have a better idea of that cross and upselling getting you back to sort of, it becomes a little bit more of a tailwind in aggregate versus perhaps a little bit of a headwind right now?
Yeah, so you rightfully point out we need time in market with different cohorts to observe behavior. You all know that we're a very data-driven organization. DDOM is at the core of how we engage with customers to optimize monetization over time. DDOM 2.0, incorporating of a broader freemium funnel, and then matriculate those customers over time. That'll take time to play out. and we'll continue to drive it. But it's something we're very skilled at, is to take our customers on digital journeys to optimize value creation over time.
Okay, and you sort of answered this, but I'll ask it just in a slightly different way, which is, another one of the questions I'm sure that Doug's gotten, you've gotten afterwards is, we've seen some of these announcements from you all around, price actions and things like that. How should we think about sort of price versus unit growth? I assume your previous comment on the broadening is sort of what offset some of the price action that you might expect if you were just doing it on an apples to apples basis. Is that a fair way of looking at it, or maybe just any color you can add on that front? Because that's sort of the other question I got coming away from the quarter.
Sure, absolutely. The growth algorithm at the company continues to be strong. As we know, there's three elements to that growth algorithm. New users, new subscriptions is the first leg of growth. Once they become customers of Adobe, we've got lots of different products with which to engage customers. So you take them on cross-sell and upsell journeys over time. That's the second leg of growth. Third leg of growth, as we all know, is pricing. All three of those elements are important contributors. The first leg, new subscriptions, is the predominant driver of growth, has been, continues to be. At Summit last year, we talked about a 30% increase in subscriptions over a 3-year period, is the predominant driver of growth, and that continues to be the case in this environment. Cross-sell and upsell, an important mechanism, and the value we're adding to our products and the adoption rate of SKUs like CC Pro, that is an important part of the pricing motion, important part of the growth algorithm. And I actually think it's indicative of the strong value that we offer customers. And so it's an important part, but it is not the predominant driver of growth inside of the company. But we feel good about the value that we're adding to our products and our ability to capture value in a smart way over time.
Great. One of the big, there's always questions, a lot of questions. You guys touch a lot of surface area, but another one that you brought up was, sort of, and you showed the demo of Nano Banana, before the earnings call, and we've obviously gotten a lot of questions on, monetization, and I, there might not be an explicit answer to this, but maybe you can sort of help us conceptualize. Because I think it's viewed as more of a threat than it is sort of an incremental for you all. So you just talk about that, and you mentioned other new models being integrated natively. So if a client wants to use Photoshop and some of the integrated Nano Banana capabilities, how does that sort of, how do they pay for it? How does it end up, how do you end up monetizing it? Can you just walk us through that? It doesn't have to be explicit, but I think just understanding conceptually how we get there would be helpful.
Sure, great question, Kirk. One of the reasons we put the video together is it really brings to life the interplay between generative AI capabilities married with precision editing to accomplish what customers want to accomplish within workflows. So we offered that video as a sneak to take a concept of these capabilities sitting side by side. What we hear from customers is that is exactly what they want. You see us bringing it to life. So it takes a concept and really brings it to life in a tangible way. Look for more sneaks in this way between now and Max, and certainly we'll have more to say in different areas at Max. But it's a great indicative use case around the pervasiveness of the Adobe ecosystem, bringing together both proprietary and third-party models in line in workflows to give customers choice and accomplish what they want to do from a workflow standpoint. That is absolutely the direction that our end markets are going, and that video illustrates that point. From an economic standpoint, the alternative, the choices that we've always been about choice in terms of image capture and workflows, and how we bring that choice to life in the era of generative AI is super important to our strategy and what you see coming together from both an ecosystem as well as an innovation standpoint. So giving customers a commercially safe option, being a strong leader in content authenticity so that you put a digital fingerprint and a nutrition label on content so people can verify where it came from. Important set of capabilities. In an ideation mode, giving customers choice on where to go for these best of breed third-party models, because they all have their own different personalities, and allowing customers embedded within workflows to tap into that ecosystem in a seamless fashion. Economically, we've got a currency, generative credits. You've got a rate card of how many credits a particular model consumes with each action, and that way you give customers choice within that consumption economic model alongside subscriptions to give the customers seamless workflows incorporating generative AI capabilities right alongside precision editing. And we think this is the winning strategy in the market. It's what our customers want. And you see that coming to fruition, bringing the entire ecosystem together. The last thing I'll say on this before I pause and see if there's any follow-ups, as you think about an Adobe subscription and you think about access organically to best of breed state-of-the-art models out in the ecosystem, it eliminates the friction for customers. Are they a subscriber of this video model, and 2 weeks later a new video model comes out with enhanced capabilities? Do they cancel this subscription and go to that subscription to get the new capabilities? All of that friction is eliminated with an Adobe subscription because we surface those best of breed models in line when they're available, natively embedded into workflows. And there isn't economic friction by subscribing to Adobe, subscribing to third-party models. And we make that work from a value creation and economically through our currency, generative credits, and a very clear rate card for our customers.
And actually take it even a step further. You mentioned Nano Banana Lockstep, kind of day one when that came out. Actually, late last week, we put out a blog that indicated we have early access for 2 weeks exclusivity to Luma's newest video generation model, Ray 3. So Adobe Firefly app subscribers and users get early access to a new model that isn't available anywhere else, which I think kind of showcases what's changed over the past couple of quarters, going from aggregating the ecosystem of third-party models to actually being a leader in terms of time to market and opening that access to subscribers and customers.
Okay. And if I think about it, and you probably won't want to answer this explicitly, but if I think about obviously paying for the model through the generative credits, I assume as part of that, there is some margin in there for you all as sort of the, I don't know, the gatekeeper, if you will, of the customers being able to access those. I assume that's where kind of you guys come in. The credits cover your cost of sort of supporting it, and then there's incremental upside from there. Is that a fair way of thinking about it?
Absolutely. It gives us flexibility through the rate card to make sure we get a set of economics that work for our partners, set of economics that work for us, and you can balance proliferation and monetization in the right way over time. So a ton of flexibility in that model to really dial in the outcome that we want.
Okay, I'm going to jump actually to one question just because I think it's related to this to some degree, which is the question was the digital marketing or digital media gross margin last quarter. You know, is there anything going on from a sort of a generative perspective that's pressuring that, or are there some other factors on that front? I think the idea is like where gross margin's going on digital media.
Yeah, so I think they've actually been really resilient as we've become a cloudier business and drive things like inferencing based on customer usage. We burn a lot of calories inside of the company to optimize the unit economics around how we access cloud from an inferencing as well as training standpoint, which makes us more resilient. But as you proliferate these features, you might see slight degradation from a gross margin standpoint, but you get a more efficient top of funnel, freemium funnel, customer acquisition, where it'll be operating margin neutral, profitability neutral for the company. And so you might see a little bit of that pressure. We're not talking about a significant reprofiling of the financials of the company, but you'll see that as you observe customers digging deeper into these capabilities that take compute off the desktop and put it in the cloud. We've been at this now 2 years. You see the trend over a several year period, but you also see a significant amount of resilience despite those underlying trends based on the calories we burn around unit economics from a cloud compute standpoint.
Okay. I'm going to hop over to sort of Express a little bit. And it feels like the Express strategy is definitely broadened out perhaps versus a few years ago, where it felt like Express a few years ago was definitely sort of the down market competitor or offering to compete against some of Canva and the like. But it definitely feels like it's now, not only in that area, but really having some success in the enterprise market in terms of being sort of a lightweight product for your non-digital marketing or your non-marketing focused folks at an enterprise. Can you just talk about those two things in separate? Because I think people like to, when they bring up competition with Canva, that that's a separate discussion than Express in aggregate. So can you talk about sort of Express's success and maybe split them that way? Because I think Express in the enterprise market's perhaps a little bit, the strategy is perhaps a little bit different than just sort of some of the things you're doing down market or in the lower end of the market.
Sure, absolutely. So as you rightfully point out, Express is a very approachable way to get customers into the creativity process. But there's two threads off of the Express strategy. One is it relates to business professionals and consumers, which is the combination of productivity and creativity. And one is in the enterprise as it relates to bringing stakeholders from the creative process into the content creation flow. So let's break them down, each of those three, into its core elements. Express, great light touch way to get more and more people into the creativity process. Birthday cards for my kids, I'm now into the creativity process. And so it's a great product for someone like me. As we drive conversational interfaces, how do you access that creative control through conversational interfaces of Express? You're going to see even more democratization and ease of use of those capabilities. And we've got a great roadmap in place, and more to say in the run-up and at Max. When we think about the application, then take that product. Oh, and by the way, when I think about the future roadmap of Express, our entire ecosystem of capabilities, the R&D around that has already been done. Those features exist. All I need to do is selectively pull from the ecosystem of features, selectively reveal that into Express workflows. And I already know what the R&D roadmap looks like because it's been bought and paid for over the last several decades. So it's a great product today, and I get really excited when I think about the future roadmap. On the business professional and consumer side, native integration into Acrobat workflows to make communication more visually rich and really strike at the heart of productivity and creativity. You see that playing out from a strategy standpoint, more work to be done on that front. That's an ecosystem that touches 1 in 10 people on the planet and over 700 million monthly active users, growing 25% year over year. So the hooks and linkages into that ecosystem around empowering customers to drive even more visually rich communications is going to be an important component of the strategy. On the enterprise side, we know that Adobe's traditional seat count in the enterprise is really around the creative process and those creative professionals. We also know that there's many stakeholders within an enterprise that can't natively engage as part of the core product portfolio that now have accessibility to the creative process through a light touch Express footprint. And they're able to get in line in those creative workflows in that more accessible way and comment in natively collaborative platform so that it's smooth, eliminates more friction and smoothes those workflows in the enterprise. So it really is a seat expansion play inside of the enterprise versus where we've sat historically. The second element of an enterprise play, with the advent of social media, with the increasing importance of social media as a communication channel with customers, and empowerment of employees to be brand ambassadors. There's going to be a push and a pull inside of companies as more and more employees take to social channels to be brand ambassadors. The traditional marketing departments are going to get scared because they want to make sure you've got high brand fidelity as you put content into the wild. Express is a great platform to lock down high brand fidelity output, but do it in a democratized way where you can empower employees to be direct brand ambassadors over social channels. That's a really important part of the Express strategy inside of the enterprise, and we get great feedback from customers. We just need continue to execute against that opportunity, and I think it's got a very bright future inside of the enterprise.
Okay, that's helpful. I'm gonna ask two others, then I'll open it up. Just on digital experience, I think, it seems like the business is sort of stabilizing a little bit in the low double digits, at least on a subscription basis right now. The question to get on that business, along with, other digital marketing companies, is sort of the threat around Meta and Google bringing more sort of native tools to bear in their customers. Can you just talk about sort of like, I assume most of your customers are not single channel, operators. They have to operate across, numerous sort of platforms, but can you just talk about sort of how if you're seeing anything on that front, or how do you see that evolving? Because I think obviously when the two biggest digital advertising players are trying to bring more tools to bear, there is some concern about how that would impact your business.
Yeah, so we're like, as the largest provider of marketing technology and creative content capability to enterprises, we've got a really strong point of view on this, and it's based on conversations with the largest enterprises and a good cross section of those medium-sized businesses on the planet, and we've got the right strategy. As you think about driving a set of capabilities that drive marry the art and science of connectivity with customers through digital channels. Nobody knows more about this than we do, both from the footprint of our digital experience business, but it's also how we run the core Adobe business. And we've done it for a very long time. It's not just a product we offer, it's deeply embedded into our DNA because we run our business with these technologies and capabilities. But our platform and solution won't be for every company on the planet. We understand that, much like SAP and Oracle won't be for the small business, the pizza shop on the corner. They're not going to run their books on SAP and Oracle. The offerings, the walled garden offerings, are going to be fine for certain businesses that don't want that agnostic way of connecting across multiple channels once their business gets to a sufficient size and scale, and have choices as to how they connect with customers. They don't want to learn 4 or 5 different walled garden environments in order to run their business. They want to build their customer experience on a single integrated platform that orchestrates that across multiple channels to connect with customers. And it's those customers that reach that sufficient size and scale, that have that vision around their business, where we see really strong identification with the capabilities we're bringing to market. You see it in the business. We're the largest provider of technology and solutions in this area, significantly outgrowing our nearest competitor. And that's become clear and clear, which tells us that we're on the right approach. So we feel good about the strategy, but it won't be for every business on the planet. But we've got the sweet spot, and we're driving hard from an execution standpoint.
Okay. Yeah, actually, just because the question popped up, is there any way to dimensionalize how many of your customers use multiple channels right now, or as a percentage of customers? I assume is the vast majority, or are there any percentage you'd give behind that, just to give a sense?
Yeah, given the size and scale, I don't have the exact number, but it's going to be virtually every company, like vast majority of them, given the capabilities that we deploy and the types of customers that we engage with. Will there be an example where maybe they run their business on our technology stack and connect through one channel? I'm sure that customer exists, but it's not the it's a de minimis minority.
Okay, that's great. I want to hit on this, which is a little bit more philosophical, but obviously with a lot of software companies, you all, included, there is a debate about, sort of the terminal value and risk. And I think you and Shanu have been pretty outspoken about, what you believe is the misalignment between sort of the durability of the business and how the stock's acting. So I have two questions around that. I guess one, and you don't have to give specifics, but can you just give us an idea of the metrics internally, whether it's renewal rates, things like that, that give you confidence in durability of growth? I mean, we see some of them, but I'd imagine there's more things you get to see than we do. And then any actions that you guys are thinking about, or I guess you can't tell me what you're thinking about, but is there a discussion internally at the board level about, how do you try to more proactively, I guess, close this gap between, the perceived, risk and what you guys believe is the reality? So sort of two questions, kind of what gives you confidence, and then, thought process about how do you guys proactively address that?
Yeah, so if we take a look at the audiences we serve and the customer groups, business professionals, consumers, we talk about driving the freemium funnel, over 700 million monthly active users, growing 25% year over year. The introduction of Acrobat Studio, which brings the best elements of that ecosystem together into a single integrated workflow that goes from consumption to creation and really puts the power of the ecosystem at our customers' hands in those integrated workflows, as well as creating knowledge hubs, which brings teams into a common shared digital environment to derive insights. In fact, Studio is an important, Spaces is an important component of how we prepare for earnings calls. We get people into that shared environment, driving insights from the repository of information that exists. So it's a foundational element of how we drive and run, and continuing to execute against that with our customers is important. When you think about creators, a Firefly app, bringing new users to the ecosystem in a web and mobile first, AI first, integrating both our proprietary generative AI models as well as the best of breed third-party models, all within that creative and ideation workflow in a shared digital space, important driver of the business going forward. Continuing to infuse these capabilities into our flagship applications to drive more engagement, more retention, but also a value accretive journey so that we better align value and the price over time with the significant capability that these products represent for the professional community of creators. Now that we've got a better segmentation of the product lineup, our ability to thoughtfully drive value capture over time in that cohort of customers is an important element of how we drive the business going forward. AEP and apps, as we think about customer experience orchestration, smart, intelligent, agentic workflows, continuing to drive the agents that we bring to market, as well as what's on the horizon. Things that exist, agents that exist now, there's site optimizers, there's insight from data standpoint, how you slice audiences, how you drive journeys. These are highly technical, grindy type motions inside of companies that you're now able to get at in a very expeditious way with agentic workflows, and you're seeing nice engagement from customers. Continuing to drive Gen Studio, that end-to-end content supply chain solution, super important part of the equation. The foundation of durable growth is alive and well, and it's just us. It's up to us now to continue to drive execution against that to deliver the durable growth. When you think about closing the gap from an investor perspective standpoint, clearly consistent execution is at the top of the list. Companies performing well, beat and raise in the most recent quarter, carry that momentum into Q4. When you think about transparent disclosures, and then followed up with capital allocation, you can see some changes that we've made from a disclosure standpoint. Things like going to an ending ARR growth rate for the year, modeling assumptions around things like operating margin, get rid of the quarter-to-quarter volatility around the stock, the introduction of customer groups, which really drives a dialogue and connectivity with how we as a company are really driving our innovation roadmaps and creating connectivity with our customers based on the solutions that solve their real world needs. Important part of the journey. And then you see the disclosure from an AI revenue standpoint, both direct and influenced over time, continuing to proliferate these technologies across the portfolio, driving towards 100% of our revenue being AI influenced because these features are pervasive across our product ecosystem. That's the strategy. That's the execution plan, and we'll continue to revisit those key metrics from a disclosure standpoint that drive that alignment, insights, and connectivity into performance of the business, and how we as a team think about driving the business going forward.
And just one follow-up to that. I mean, you mentioned, engagement, retention. I assume, are these KPIs that you guys are monitoring internally? I know you're going to share what they are with us, but are these the things that you're seeing and that give you confidence? I mean, you mentioned a lot of sort of product initiatives, but the durability when it comes down to just the metrics that you're watching, I assume the level of engagement, the level of retention is where you'd want to see them to feel confident to say things are durable, correct? I assume that's the case, but I just want to double click on it.
Yeah, so the umbrella statement is we see strong, consistent retention and engagement rates across the product portfolio. No material change there. That said, where we do see AI, generative AI feature engagement, you see stronger engagement in the product, and you see a better retention signal over time. So we're going to stay focused on proliferating these innovations and capabilities natively embedded into the product portfolio, because we like the signal in the underlying data when customers are heavy users and consumers of those capabilities.
Okay, great. We did have one question on the line, so Tim, you should be able to go ahead and ask it if you want.
Yep. Can you guys hear me all right?
Yeah, and Tim.
All right. Thanks for making the time to chat with all of us, Dan and Doug. So just my question, I think the step function change and model capabilities over the past 6 months or so is super exciting for you guys and can be an accelerant for the business, especially when you consider like the compute intensity on video, where I think like 45 seconds of VO3 on your platform burns through like $30 worth of generative credits, which against like a CC Pro list price of 70 is a pretty compelling uplift. And I think the points you laid out earlier resonate on why you guys should benefit. But a few questions related to this to like draw a finer point. Just given how expensive the consumption side can get, where is this budget coming from? Is there budget there today? How are these consumption credits getting shared at an organization, either under E4 or VIP or Teams purchasing? And then on the rate card side of things, I guess the markups seem like they're anywhere from 10 to 100% plus relative to like the first party API pricing, and depending on how current the model is. How are you guys thinking about that and how frequently that needs to change? And then just how we should expect kind of any revenue from the generative credit side from third-party models, like what the margin profile of that business should look like.
Yeah, so a lot embedded in there. Let me try to unpack it. And if I don't hit on some things, then please follow up. Where does the budget come from? If we think about the capabilities that get unlocked, and you referenced a video model. So as you think about the creative process, there's ideation, there's capture, there's production, and then there's doing something with the content by activating it in the market. The ideation side of the house, you can explore far more surface area by engaging with these technologies. When you think about capture, and you want to do a photo shoot or a video clip and it's got a beach scene in it, rather than flying the production crew to Bora Bora or Tahiti or wherever it is for a couple weeks so that you can capture all of the raw footage, you're now disintermediating that spend with a software solution to give you a great starting point from a content capture standpoint. And so there's a whole host of expenses that go into the capture process of professional content that get disintermediated with a software solution. So the headroom with which to drive economics from adoption of these capabilities, I think is really encouraging as we drive more software enablement of that end-to-end creative process that spans ideation, capture, production, and then activation. So I feel really good about that. When we think about usage, right now the rate cards are set, both initial allocations as well as the rate cards. We're orienting towards proliferation. We see good long-term signals in terms of engagement and retention when these features are adopted. We don't want generation credit anxiety to take hold and limit initial levels of adoption. We can adjust frequently how we turn the dials to make sure that we really level set the economics around how we drive adoption of these capabilities in a way that's attractive for customers as well as us. And when we think about productivity that comes from these types of technologies, one, you've got the physical cost of content capture that we talked about. We talk about enhancing the surface area of workflows and the productivity benefits. You know, as you think about the trade-off between content production automation and a seat license. Today, a seat license, let's say, is $1,200 a year. The salary of an individual is $250,000 a year or $200,000 a year. The headroom of the opportunity that we're driving into, whether you talk about productivity or whether you talk about things like disintermediating physical photo shoots with these technologies, there's a ton of headroom from a value capture standpoint. And so we feel good about the long-term sharing of economics that work for customers and work for us as a company as we more deeply embed and proliferate these technologies across the pervasive workflows of the Adobe ecosystem.
On the margin side, you know, it sounds like then that might be a bit more fluid near term for revenues directly associated with third-party models. Is there a framework to think about how that layers into the business over, call it like the next 1 to 2 years from a gross margin perspective?
Yeah, so the best guidance I can give, and I've kind of alluded to this in prior conversations, so this won't be net new, it'll just reinforce our worldview. I do think you'll see a slight degradation. I'm not talking like 5 or 6 points of gross margin, a slight degradation. Maybe there's a point, maybe slightly more than a point or two. You make it up on a more efficient top of funnel motion as you proliferate these technologies through the freemium funnel virality of products bringing people into the ecosystem. And I would expect it to be a net neutral from an operating margin standpoint. I think you will see that slight reprofiling play out. Now, that said, I've been talking about that for 2 years since generative AI has become a thing. And the calories we burn on unit economics around cloud compute have fought that trend, and the company's gross margin into this inflection, despite a spike in adoption, has been very, very resilient. We're going to continue to burn calories and do the hard work to fight against that trend. Over time, I would expect there to be a little bit of degradation made up on a more efficient go-to-market motion and freemium funnel. Net being neutral from an operating margin standpoint, if that makes sense.
Thanks, Tim. I'm going to run through a couple. We're at time, so I'm going to try to do a rapid fire with you, Dan, which would be, just margins in general. I mean, we're at another analyst day, and a CEO mentioned to some of us around that, like these are people-based companies. In an AI world, efficiency should be getting better across most software companies. I think you guys were one of the companies that didn't sort of run out too far and too fast around COVID about hiring, so you haven't had to do like the rift that some others have had to do. What do you think? I mean, how should we judge you on that front? Because I think you would obviously want to see productivity from an R&D, sales and marketing, might offset gross margins, but gross margins, some of the degradation you just referred to. But do you think you have an opportunity to enhance productivity at Adobe through AI over the next few years? And like, how should we measure you all on that basis?
Yeah, so from a baseline setting standpoint, through the investment cycle, you can see the margins that we're putting up, 46.3% in the most recent quarter, and the investments that we're making underneath that profile are substantial. We burn a lot of calories, as we talked about, on unit economics to make sure that those activities are done in an efficient way, and we're delivering value for shareholders. You can see the disconnect between the top line progression and the rate of headcount adds over the last 3 years. Let's say the top line around 30% growth in the last 3 years. Headcount is growing slightly over 6% over that same period of time. So you see that disconnect as we drive productivity gains into the enterprise. So I would, on a prospective basis, we talk about mid-40s through this investment cycle, and we've been doing a pretty good job executing against that. As we progress forward, engineering throughput, how we enable our engineering teams and the velocity of innovation and productization of that innovation, I would expect that engineering throughput to continue to go up. Unit economics around AI workloads, I would expect us to continue to be and drive world-class outcomes. This is really a dynamite team doing fantastic work, driving real efficiency into the ecosystem. I think we're world-class in this, but we're going to continue to make progress. Things like sales productivity, continue to drive more productivity with generative AI-enabled conversations that talk about next best actions with customers based on current footprint they have to drive more juice out of a cross-sell and upsell motion and the breadth of the Adobe portfolio. And then, of course, operating leverage over time. With scale comes expectations of operating leverage. 2/3 of our headcount adds in the last couple of years are all in R&D, and you can see the efficiency with which we're running other parts of the business. We're going to continue to drive that operating leverage as the company continues to scale.
Okay, last one for you, and I'll let you run. And thank you again for the time. I think you touched upon this a little bit in the earlier comment about sort of the broadening of the base, but another question sort of on pricing, meaning the question was sort of like, why is net new digital media ARR was down, I think, 1% in the quarter, given, and I think people are saying there are more tailwinds from a pricing perspective this year. Why is that not, I guess, why aren't you seeing the pricing dynamics flow through as much? Can you just answer that? I think I think it gets back to some of the broadening of the portfolio on DMAR or just on DM side, but can you just touch upon that? Because I think that came up again.
Yeah, so I think it's the wrong conclusion to say pricing is more of a tailwind in FY25 than it was in 24. That's an incorrect statement. And so I'd start there with the assumption that frames the question. And 24 and 25 are less contributors than they were in 23. There's a broadening of the portfolio. It's not like for like, we're the only variable inside the company that's changing is pricing. It's a complex equation across this broadening of the portfolio, driving value accretion in a professional set of customers, and the value we're adding. The adoption of the CC Pro SKU has been fantastic, which is an indicator of value. So the fact that we're able to drive pricing in an environment like this, I think, is a feature and a strength, not a weakness. Predominant driver of growth continues to be new subscriptions, but they're coming in at different points of the ecosystem based on more choice and meeting them where they are, whether it's the surface or the use case specific needs. I think the long-term retentive value of that strategy will play out over time, and we feel good about how we're building the foundation upon which future growth will be built.
Cool. Well, we went a little over time, but Dan, Doug, thanks very much. I know we didn't get to every question. If you have a follow-up, I'd suggest you just email Doug. I'm sure he can get back to you pretty quickly on that front. But thanks, guys. Look forward to seeing you down in LA in a month or so. And I appreciate the time.
Thanks again, Kirk.
Thanks everybody for joining us. Take care.
Bye.